Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Mansha Gupta. And let's get straight into the most volatile space of the week, and that clearly has been the crude oil prices. The oil prices are not too far from the one-year lows due to the supply buildup in the global markets. US, Russia and Saudi Arabia are all dominating the global supply, producing more oil than the other 15 members of the OPEC. All three are pumping at record rates. The US crude output is at 11.7 million barrels per day, while the Saudi is pumping in at 10.7 million, and Russia is at an all-time high at 11.4 million barrels per day as well. The stockpiles in the developed nations of the OECD are rising again after the rally since early 2017 and is likely to exceed their 5-year average level when the October data is finalized. The OPEC and the allies are set to meet on December 6th to decide the output policy for 2019. And that is when the markets will get a clearer direction on what 2019 actually can look like. In the meanwhile, take a look at the prices, where we have seen the US crude down by 8% in this year until time. And if you look at the Brent prices, those are down 1.5% as well. Remember, we started this year on a positive, and until the first half of 2018, we were still positive for the crude oil prices. But it really has been the last 6 or 7 weeks when we have seen both the crude varieties decline between 29 to 31%. And that really, of course, has been damaging on the charts as well. But on the other side, when you look at the natural gas prices, that is the only one actually which seems to be closing this year in the positive. That one is up 42% as compared to last year, and that's because of strong demand and the supplies which have continued to decline. We also have the commodity champion of the week, and that is Vikas, Halan, Senior Vice President, Corporate Finance at Moody's, who joins us now to talk about that space. Vikas, hi, thank you so much for joining us. And it really is about the crude oil prices that the global markets are talking about, the high volatility that we have seen in prices. How would you look at that? And would you say that the crude oil prices as of now have factored in much of the fundamentals, or is it going to continue to react to every data, every statement, every micro, macro numbers that we tend to see?
Yeah, hi Manisha, thanks for inviting. It's always a pleasure. Crude oil prices have been volatile, and that is in line with what we have expected. Ever since October, when oil prices were closer to $85, we have maintained that the fundamentals do not support crude prices to be that high. They were high in the run-up to the sanctions, and the sanctions did get waived off. And therefore, the oil prices saw a bit of decline with further production increase coming out from US, that we have seen the data coming out also provides some downward pressure on the oil. But still, the fundamentals continue to support oil prices within a range of $50 to $70. That is what we maintain. From a rating perspective, we are more interested in the overall annual averages of the prices. So the volatility, as high as it may be, the averages continue to be within the expectation for this oil price band that we have, and will continue to remain within that, because the fundamentals still continue to have a very strong demand growth on the oil versus the supply. Production cuts that OPEC is talking about will support prices at the range that we just talked about.
So, Vikas, how important is the December 6th meeting now going to be? How much would you say hinges on it? Because the last couple of years have been important because of OPEC and allies continuing to cut output. How much, for how long, what allies would need to join in for this now?
But we already know what OPEC is talking about. Saudi Arabia is in favor of cutting production, and there seems to be some sort of consensus on what oil prices that they would want to target. What we have seen in the past is a $60 is something that OPEC wants to maintain at a minimum, and that would determine, well, by the time we get to December 6th, if oil prices are somewhat closer to that or below that, that would allow Saudi Arabia to convince others to join in the production cuts. And let's not forget, there is Russia as well, which is got very large portion of global supplies. And if oil prices fall materially below 60, we will see those production cuts coming in, and that will provide support to prices.
So, Vikas, how do you look at the U.S. production at this level? As you mentioned, I mean, the notion in the market is that the U.S. president kind of fooled the OPEC and Russia into increasing supplies, and then, of course, gave generous waivers to Iran sanctions, and that means higher supplies heading into 2019. How do you see the situation 6 months on from here, when we will see higher supplies in the global markets? The Iran sanctions, the waivers, that is, will ease off as well.
So there's going to be quite a few things to look out for over the next 6 months. Of course, the December 6th meeting and decisions taken at that time, the impact of that, production cut, whatever the size may be, will be felt with a lag effect. And then you would have the U.S. production coming in towards the second half, because there is a bit of a bottleneck in terms of pipeline for evacuation of the production. That we think will ease out in the second half of 2019. So U.S. production will increase further by 2019, provided oil prices stay supported by till then. In any case, oil prices will stay volatile. There is, of course, the waivers that will been given for a period that will expire. So oil prices will not be stable anytime soon, and we'll continue to see volatility.
All right, so we are going to live with more volatility. So what's your sense when it comes to India then? Because I understand the volatility is not so good for the producing countries, but for the consuming countries, where the imports bill of course might go down, but the export of petroleum products, how big is the concern of that?
I mean, volatility is going to be there, but it is going to stay range bound at the same time. You're not seeing $120 on one end and $20 on the another. We are looking at 50 to 70, or maybe 60 to 80 sort of a price band. So it is range bound volatility. Yes, there could be percent-wise, if you look at it, things might seem more volatile. From an import-oriented country perspective like India, yes, volatility would mean that you would need to see price changes happen on a regular basis, and that would mean the oil marketing companies will be particularly exposed to that, price changes, especially if they're not allowed to make price changes. With an upcoming election in 2019, if there are sort of unofficial price freezes, for example, that might eat into their marketing margins. So volatility poses risk for marketing companies, and especially if the market prices are not aligned, or the selling prices are not aligned with the market prices. For the upstream companies, the volatility, if it stays range bound, is not going to move the needle too much. Maybe there is going to be some bit of, exposure to inventory losses for the oil marketing companies, but for the upstream companies, because if you look at it on an average basis, if oil prices stay above 60, I think things are going to be, pretty much unaffected from last year.
Oh, well, yes, and until we don't see the diesel and petrol prices in India at all-time highs, a string of that, of course, that has been bothering. But, Vikas, it also has been 2 years since the OPEC and allies have been on an output cut policy, which we will see in 2019 as well. Do you think that they need to increase the quantum in terms of supply? Because as we just spoke, Saudi Arabia, Russia have been increasing supplies in the last couple of months.
Yeah, for OPEC to cut production further when oil prices are still above $60. If they take that view, they will definitely need to think about or compensate for the supplies coming in from US. And 2019, as I said, might be a year where we see further increase in US production because of the completion of pipeline and other infrastructure bottlenecks. So I would not rule out further increase in production cuts from OPEC to support prices, but I don't think they would be targeting, or they would be right in targeting, a price that is significantly higher than 60.
All right. So one final question, Vikas, before we let you go, and this is on the Indian markets yet again. The imports, of course, as of now do continue from Iran, and the notion is that the dependence on imports is only going to increase from 80% right now. So if the Iran sanctions would be imposed in the next 6 months, what markets do you think India will then turn to? Is it going to be US, Russia, Canada? Do you see all of those countries then come into play?
Yeah, definitely. India would do well to diversify the sources of imports. At the moment, the dependence on the Middle East is quite high. As one of the two largest economies in the world which relies on crude oil imports, India can't just be sourcing crude from one region. That exposes the risk. So, yeah, India would do well to diversify its sourcing, and they have been doing that. So, beyond Middle East, of course, as you pointed out, US, Canada, Latin America, and even Russian crude. So those are the largest producer, and that's where you would go.
All right, Vikas, we'll let you go at that. Well, that clearly is the view coming in from Moody's and from Vikas Halan, saying that the crude oil prices from here on will be volatile but will continue to stay in a range. But going forward, much would really depend upon the December 6th meeting. And then, of course, you also have the G20 meeting, and the markets will continue to look at the Iran sanctions 6 months down the line. So plenty eventful for the next 6 months as well. Well, with that, let's go for a short break. But when we come back, we'll talk about the industrial metal and the precious metals as well. A lot of volatility has been seen onto that one as well. This is yet another month that is closing in the negative. But we will get you all the details from two experts who join us from the S&P Global Platts.